Alrighty, good morning. This is Uday Turaga, founder and CEO of ADI. Welcome to ADI's webinar series on oil and gas in the perfect storm. This is the first of a series of webinars that we will be hosting over the next 5 weeks. Each webinar will be on Thursday, same time, 11 a.m. Central. We'll quickly introduce ADI today in terms of agenda, and then we'll talk about some of the insights focused on upstream oil and gas markets, and then we'll have a Q&A session. Very quickly, for those of you who don't know us, ADI is a boutique consulting firm. We focus on oil and gas, energy, and chemical markets. And within these markets, we work across the value chain. So if you take oil and gas, for example, we work in upstream, midstream, and downstream markets. Within chemicals, we work on both commodity and specialty chemical markets. We do quite a bit of work in energy as well, but a lot of that work focused on power and utilities is fairly opportunistic. We've been around for the past 11 years. We have supported over 150 clients, and we have completed over 400 projects. The way we differentiate ourselves in the market is in 3 ways. First, we bring deep industry expertise. Second, we leverage data and proprietary analytics to drive a lot of our consulting firm. And then finally, as a smaller firm, we are a lot more responsive and client-centric relative to some of our larger peers in the consulting space. So this is a select list of our clients over the past 11 years. You'll see that we have worked with a broad range of clients. We've supported the large oil and gas majors like Exxon, Shell, and BP, a number of independents like ConocoPhillips and Marathon, a number of chemical companies, a number of companies selling equipment and services into the oil and gas market, and then, of course, private equity and venture capital investors. We help clients in multiple ways. Most of our work is custom consulting work. Clients come to us with a specific scope of work, and then we execute around it. We help clients develop and build strategic plans, help them with go-to-market and market research to support their sales and marketing efforts. We help them understand financial issues and also support functions like procurement and innovation. Since early March, we have put a team together that's focused on understanding what's happening in the oil and gas market today. And if you followed some of this research, you know that we are using the perfect storm as a metaphor for describing how the market looks like today. Clearly, we are in some sort of a double whammy with the oil price crash coming from the oversupply in the market, followed by the demand impact from COVID-19. We have a specific page on our website. So if you go to adi-analytics.com, you'll see a pop-up that will take you to the page on COVID-19, where all of this research will be organized and made available. That's also the place where you can sign up for our future webinars. So as I was mentioning earlier, we have 5 webinars coming up. This is the first. This one focuses on upstream. We're going to talk about midstream next Thursday, a couple of weeks from today, downstream, refining and fuels markets. And then late April, and early May, we'll cover natural gas and LNG and petrochemical and plastics markets. Again, you can sign up for all of this on our website. We have a new report that's now available that focuses on helping clients navigate the oil and gas perfect storm. We'll talk a little bit about this at the end of the call, but some information about this report that does a much deeper dive into some of the key issues that the industry is facing today is also available on our website. So in addition to myself today, I'm joined by a couple of my colleagues. Panusweet Vivedi is an analyst with ADI, and Utkarsh Gupta, also an analyst with ADI. Both of them are petroleum engineers by training. They have worked in on a number of upstream oil and gas research and consulting projects. After we go through the presentation, we'll have some sort of a short panel discussion where they'll share some of their insights. They are closer to the coalface because they work in these markets on a daily basis and can share some of their insights as they are researching what's happening in the larger oil and gas landscape today. Clearly, we are in uncharted waters here, given how significant the collapse in oil price has been since early March. The reason we are here is because OPEC and Russia, the deal that they put together in late 2016, collapsed in early March 2020, primarily due to Russia. Russia has been taken a new stand insisting that US shale has to cut supply in order for them to agree to some sort of a supply cut. So following the decision in early March, OPEC, led by Saudi in particular, is raising output. Saudi is currently producing about 10 million barrels per day. They intend to raise that up to 12 million barrels per day, a little over 12 million barrels per day. But some of that is going to come from inventory, about 500,000 or so. Saudi's position is very clear. They want the OPEC plus alliance between OPEC and Russia to continue and agree to supply cuts to stabilize prices back in the 50s. Russia, on the other hand, produces a little short of 11 million barrels per day today. They don't have a lot of room to raise output, unlike the Saudis. The Saudis are raising output by a little over 2 million barrels per day. Russia can only raise by as much as 500,000 barrels per day, primarily because of ongoing sanctions against their production and exports. Their position, as I mentioned earlier, has been that they want US shale to also cut supply before they will agree to a deal. So in early March, following the supply cut, when we modeled the supply-demand balance, essentially we estimated some sort of an oversupply of close to 3.3 million barrels per day. The picture has actually changed quite dramatically since then. If you look at demand now, demand is no longer around the 100 million barrels per day, or a little short of 100 million barrels per day. Forecasting at that point of time because of COVID-19, and we'll talk about this in a little bit. There has been a significant impact on overall oil demand. So we anticipate this oversupply to increase quite significantly. So when we factor in the supply enhancements coming in from Saudi and OPEC, more broadly, we also are generously giving Russia the ability to increase supply by another 500,000 barrels per day. We think that US shale would have to cut at least 2 million barrels per day in order to meet that old demand outlook that we had shared. So even when we were assuming that demand would be close to 100 million barrels per day, it was a pretty steep cut for shale. A 2 million barrel per day cut translates into something like 25% of supply reduction just for US shale producers, and about 15% or so for overall US production. So that's a pretty significant supply cut that the US would have to prepare for. Now, of course, things changed dramatically in the past couple of weeks. Today, a third of the global population lives under some sort of a lockdown that collectively has threatened about 2/3 or has impacted about 2/3 of oil demand. About 30 countries today are in some sort of a severe lockdown. Only a handful of them are in moderate lockdowns. Even in countries that don't have official lockdown mandates, citizens are being fairly cautious and have voluntarily imposed limits on their activity. So we actually expect that there's a greater share of oil demand that has been impacted because of COVID-19. Collectively, we anticipate something like 15 million barrels per day, so about 15% of oil demand being destroyed in the first half of 2020. This is a little lower than a couple of estimates that are out there, and a little bit higher than some of our peers who have put estimates out. But there's a lot of uncertainty in this number. it's hard to get a true estimate of how big this impact has been. Our modeling has relied on oil demand consumption patterns, fuel demand consumption patterns in the countries under lockdown. We've tried to estimate what kind of an impact there has been on vehicular traffic in order to estimate our impact. But in general, we expect something like 15 to 20% of oil demand being destroyed in the first half of 2020. Collectively, we think that global oil demand for all of 2020 will be impacted by about 10% at 10 million barrels per day. So this is a pretty significant blow to the industry. And in response, we are seeing a wide range of actions, primarily around project deferrals and capital and cuts in capital spending. The US shale has responded and has cut capital spending by about 25 to 30%. We think that is insufficient at this point of time, given how bad the outlook looks like. Several offshore projects have been deferred, and some of the marginal assets, in particular stripper wells, have actually already started shutting in production. We do a little bit of work for the stripper well community, and we were on a call earlier this week where stripper well operators were talking about how they had already started shutting production in because they were getting oil prices of close to $10 to $15 a barrel, which is not economic for them to sustain operations. So we talked about this a little bit earlier, but collectively about 30 billion in capex has been cut. So far, we have some of the players that have cut capex here. This is just capital cuts from public companies. We anticipate that some of the private equity and other private players have also cut capital spending. And collectively, we expect the total number to be a little bit higher. But the bigger issue is when we compare these supply cuts to the actual anticipated reduction in supply or in oil production, we don't see a lot of oil production coming off the block. Some of this might be because the supply cuts are not deep enough. About 25 to 30% is essentially enough to reduce drilling levels, but is not large enough to significantly bend the supply curve. And we anticipate the need for further supply cuts in order for US shale producers to meaningfully impact overall supply. So as we speak, so thinking about what happens next as we speak, OPEC, Russia, and a couple of the G20 producers are meeting in Vienna today, or actually are meeting via teleconference, there is preliminary news of an OPEC plus deal. So essentially a deal between Russia and OPEC led by Saudi, where they're talking about something like 15 to 20 million barrels per day. Of course, a lot of details have to be ironed out, and we've heard that they are haggling over the baseline in terms of whether the baseline should be off of the beginning of the year in 2020, or should be based on April 2020 production, because some of them have already raised their production. So some of these details will actually have a pretty big impact. Initial market feedback around the news of this deal has been negative in the sense that the market believes that the supply cuts are not deep enough. And there's also a significant level of uncertainty around whether the G20 producers, primarily US, Norway, and Canada, will figure out a way to join this deal and commit to supply cuts. So in terms of scenarios and thinking of what all of this means going forward, if we see some sort of a deal similar to what we saw in December 2016 between OPEC and Russia, we see that as some sort of a moderate outcome. We think that oil prices might stabilize in the 30s because of that. The ideal scenario would be some sort of a deal that includes supply cuts also coming in from G20 producers. And this would mean going beyond the cuts that US shale has made. This would envisage some cuts in other US oil production as well. To what extent is that possible under the current legal framework is not certain. But that would be the ideal outcome. That we think would enable the oil industry to kind of position itself for the demand decline that we have seen in 2020 and potentially raise prices into the high 30s, maybe even the 40s. And then a grim outlook is, of course, if there's no deal coming out of the meetings today and tomorrow, we anticipate oil essentially collapsing to the marginal supply cost, which is $10 to $15 a barrel. So at this time, let me open it up. We'll quickly go through this because we lost a little bit of time because of the technical challenges earlier. But there are a couple of key questions that we have here, and I'd like my colleagues to chime in. Let me start with the question on US supply. What US supply do either of you, Panusri, Utkarsh, think is going to be cut going forward? I think you're on mute, Panusri.
Yeah. Yeah. Good morning, everyone. Okay. So yeah. So talking about the U.S. oil production, we see that about 8% of the near to 12 million barrels per day of production that we have, 8% of oil, 9% of natural gas, and 6% of else come from the federal lands. And talking about the federal lands, Gulf of Mexico production is nearing 2 million barrels per day in 2019. So looking at that, we see that the second step after the private and the public E&P producers, when they start finding some of their marginal wells to be not as economical, after they cut their production, I think the highly risk is on the Gulf of Mexico production, which I think would likely be cut in case US needs to cut the production.
So, Chris, you've been doing a lot of work in offshore. You published a blog recently on offshore oil and gas markets. What do you see in offshore, specifically from a US point of view? Is Gulf of Mexico production at some sort of a risk?
Hi, good morning, everyone. So, Uday, talking about Gulf of Mexico, in general, the oil production from the US federal waters in the Gulf of Mexico is growing at a good pace. And right now it's at around 2 million barrels per day, which was around 1.7 million barrels in 2017. And the production in a normal way was expected to increase by another 40,000 barrels per day with the planned production of 10 new fields that are coming from Shell, Oxy, LLOG, Murphy Oil, Talos Energy, and BP. In general, the amount of time that is needed to discover and develop a large field makes oil production less sensitive to short-term oil price movements. However, right in the current scenario, the federal government the oil production at Gulf of Mexico is at risk, as the federal government might cut the oil production significantly from Gulf of Mexico. And recently, we have heard that there have been few cases of COVID-19 here also in Gulf of Mexico, which have been tested positive. So that might also end up in some kind of production decrease in Gulf of Mexico.
Okay, so what you're saying is that from a fundamental economics point of view, from a fundamental operational risk point of view, we see some risks to that production. But what about risks associated with, let's say, an executive order, because legally the US cannot quite force oil production from private assets to be cut, but are there other options to cut US supply, and would that put offshore or onshore at some sort of a risk?
Yeah, I think lowering the flaring the flaring limit, lowering that as a regulatory form could harm some operators who have a high gas oil ratio and who are flaring a lot. So maybe that is one another way that supply can be cut.
Okay, but Utkarsh, do you see potentially limits on federal lands impacting, say, Gulf of Mexico production?
There might be some because most of the production is coming from the federal land. So if there is a need of decreasing the oil production by 2 million barrels from US, then there might be some kind of executive order coming from the federal government, and the producers might be forced to cut the production, which is not preferable because there is a lot of capex involved in offshore developments, but that is the only way, that is one of the way, and the production is at risk from Gulf of Mexico. And there have been talks in the White House regarding that as well.
Okay. So if you go think about beyond the US, what other supply is potentially at risk?
So I think as the oil price decreases, and we imagine that the fields that have been considered marginal, that the definition could change. So oil sands could be at risk. There are other maybe Uday, you can elaborate on it. But according to me, I think the definition itself of marginal fields could change because of the oil prices.
Because the break-even is now changing, right, in multiple ways, right? I mean, the break-even isn't changing, but there's not enough room for the break-even to be higher.
Yes.
So Utkarsh, how, we were talking about this question earlier this week internally, like how low can oil prices go? So what is like a super pessimistic view of the oil price market?
Yeah, that's a very interesting question. Like, we have been reading a lot that some of the analysts are saying that the oil prices may go negative as well. But in general, according to our models, what we see is that right now the commercial oil storage stockpiles available is around 67 million barrels. And when we talk about the federal stockpiles, the available storage capacity is around 80 million barrels. So now there are two drivers which might end up in prices to go down further in the coming quarter. And one is the access to available infrastructure for a producer to transport oil, and the other is the access to storage capacity. So a lot of analysts are predicting negative oil prices. Right now, when we talk about the Western Canadian Select, it's already below $5. The WTI, it can reach to around $10 to $15 as storage capacity further tightens. Talking about the offshore producers, there is access to export market or shipping storage is available, but federal government or federal regulations might end up in cutting some production from GOM. Talking about the capacity, the Permian storage capacity is almost full. Cushing is filling fast, and the producers, the negative oil prices will be mostly driven by landlocked producers that fear reservoir damage. So there might be a sharp decline in oil prices in the coming months if the OPEC plus deal is not successful or something like that.
Excellent. That's helpful. So let's take a couple of questions from the attendees. I have a couple of questions coming in. The first one is on stripper wells. What is a stripper well? So stripper wells are wells that produce typically less than 10 barrels per day. Collectively, the US has about 500,000 barrels per day of supply coming from stripper wells. These are traditionally have been on conventional oil and gas resources and fields. There's a pretty big, with less than 10 barrels per day and 500,000 barrels of total supply, you can imagine there are a number of stripper wells out there. And this is the segment that's been impacted pretty significantly at this point in time. We have a second question here, and Panusri, maybe you can take this. How do you see the impact on oil field services? You've been working quite a bit in the oil field service space. How do you see the oil field service segment getting impacted?
So I have frankly personally seen the oil field services being impacted. We see that the leading service companies like Schlumberger, Halliburton have been furloughing their employees. The smaller, the fracking companies, the frack equipment companies are the ones that have been very severely hit. I know some companies who've been drastically reduced their fracking fleet by 50%. Some companies are in a position where it's either to retain their employees or they're selling the equipment as scrap to get the value out of it. There are certain OEMs who have projected their own company projections have been significantly lower because of slowdown in incoming projects, as we see that newer projects are being stalled. So OEMs are also being affected. So I think it has taken a big hit, and it is going to take a while before it catches up to the highs that we have seen.
But I think collectively we expect a lot of consolidation potentially. Although I think if you look at the 2014 price crash, the consolidation didn't happen right away. It took a year before operators or before oilfield service companies and investors started really thinking about consolidation, because the shock is, it takes a while to for the industry to process that and figure out what are the assets. So I think there'll be consolidation, but probably it will take some more time. We're going to go a few minutes over because there are questions still coming in. We have a question here on price sensitivity as crude supply is cut. And maybe, I'll take a stab at this, and Panus, you can chime in, but that is exactly what we are trying to do as part of our scenarios work in this project, right? In this new report, right? It is truly hard to understand or forecast with a great level of accuracy where supply is going to be cut. But where supply will be cut will have a pretty big impact on what the outlook for oil prices will be. If we anticipate a significant reduction, let's say in shale production, we would expect oil prices to rise relatively quickly. But let's say if the reduction is coming in primarily from, let's say, offshore assets, I'm not so sure if that is enough of a signal to drive an increase in oil prices. But that is exactly some of the stuff that we are working on, and maybe this is a good time to quickly cue in our new report on the oil and gas perfect storm. This is a very comprehensive report that's primarily designed to help clients develop strategies to navigate this perfect storm that the industry is in today. We'll start with an assessment of where with an assessment of the background and key geopolitical drivers that have led to the oil price crash. We'll do an in-depth assessment of demand destruction from COVID-19. Then we have deep dives that will cover upstream and look at the oil supply demand balance, and then develop price scenarios going forward. And this will be based on some of these scenarios around where some of these supply cuts are going to come in. Then the report covers 4 different segments. In addition to upstream, we look at midstream, refining, natural gas and LNG markets, and then finally chemical and petrochemical markets. And then we wrap up with 4 sections that focus on the so what, or the strategic implications of all of this, right? What does all of this mean to capital spending, operating spending? What are the implications for investors? And then, of course, finally, we'll wrap the report up with key findings and all that stuff. So reach out to us if this report is of interest to you. So with that, let me start wrapping up. We're already 5 minutes over. We have 4 more webinars coming up. The next one's next Thursday, same time, and it'll focus on midstream. I'll be again joined with a couple of my colleagues who research and work in midstream markets, and we'll have a similar format. We welcome feedback on the webinar today. We'll obviously do our best to address the technical issues, but if there is other feedback that if you can share, we would welcome that feedback, and we'll try to address all of that. With that, let me close the webinar today. Thank you for joining us, and look forward to seeing you next Thursday.
Yeah, thank you, everyone.
Thank you, everyone.